I'm happy to introduce you to today's speakers, Marty Karaman, leader of our Tax Credits and Incentives Advisory, along with Carolyn Smith Driscoll, director with our Cherry Beckert Tax Credits and Incentives Advisory. So please, Marty, take it away.
Absolutely. Thank you, Maddie. And thank you, everyone, for joining. Carolyn and I are going to try to keep this conversational and interesting for everybody on the line, hopefully educational as well. We've been doing this monthly due to the fact that the employee retention credit is still probably both in the news for both good and bad reasons, and also probably you've still seen a barrage of marketing materials on it. You may have claimed it, you may be thinking about claiming it, you may not know anything about it and want the CPE. Either way, we're going to go through it. And the focus today is a little bit on Cherry Beckert's service delivery model and how we differentiate ourselves, I think, from others out there, especially the consultancies where you've been seeing quite a bit of advertising, or who knows, maybe phone calls directly to your cell phone, pitching the fact that you can get up to $26,000 per employee, which may be true, but not true for everybody. And it can be something less, it can be nothing. But we want to go through, I think, eliminate some of, some of the false information out there, cut through the marketing, make you aware of what the IRS is looking at right now, but just beginning a bit from a service delivery model perspective, we're going to do this a little bit backwards and talk about some of the topics of high interest, some industry examples, how we approach this, how we work with clients, and then get into some of the rote rules toward the end, because I have a feeling a number of people on this call may be familiar with the ERC regime, and they may already have questions about it. So we're going to take it that way. So why don't we move on to the next slide? Wonderful. So we have a polling question. How did you hear about this webinar? One, Cherry Beckert tax advisor, an email from Cherry Beckert, a friend or a colleague, Cherry Beckert alumnus or alumni, or a social media post, or alternatively, a podcast advertisement, a YouTube video. Whatever you've seen, it has been so heavily advertised. What I've seen out there, and I'm just going to keep talking while everybody answers this thing, but there's so much advertising, and it's on like talk radio as well. You'll hear just like, hey, and it's not even labeled employee retention credit. Sometimes it's just like, hey, there's a credit to which you're entitled. Again, basically just so we can level set before we get into some of the high level industry examples. This is a credit intended to basically provide a benefit to companies who kept people employed while during the 20 and 21 time periods. There's 4 credits. There's one for 2020, one for each of the first 3 quarters of 21. To the extent the company was harmed by COVID-19 orders in some way. And I don't know if we showed the poll results there or not, but it probably doesn't matter. Again, you qualify for this thing if basically government orders were limiting what you could do or what your clients could do. And if it's a government order on your clients, it's measured through some decline in the gross receipts, basically the sales to the company on a quarterly basis compared back to the quarters of 2019. Alternatively, if you have, there we go, most people heard from an email from Cherry Beckert. So good job to my team here, who's been emailing everybody. So wonderful. To the extent you were partially shut down in 20 or 21 due to government orders on your business, limiting commerce or travel or group meetings, or potentially maybe on a supplier of the company, you might have an indirect ability to qualify. We'll get into that more. I'm sure there may be some questions in the Q&A on that as we go through it, but here's what we start with. Whenever someone approaches me within the firm or outside of the firm, I send this email to them just to level set. We don't need everything for a scoping call, but here's what we're going to talk about. Essentially, this is a payroll tax refund available to companies. And so we have to get the payroll tax returns. Those are the 941s for 2020 and 21. Technically speaking, the credit exists for the 2020 period from March 13th, 2020 through December 31st, 2020. So that's reported over the quarter 2, 3, and 4 941 period. So you would file a 941X for those. If you work with a PEO, professional employment organization, generally speaking, those arrangements require the PEO to do the filing on behalf of the client. And so there's not as much we can do for clients that work with PEOs, as much as just help them get assurance that they do qualify, and for what time period. And then they have to work with the PEO to basically go through the PEO and have them file for it. But anyway, so we talk about what they file from a 941 perspective. This is a payroll tax refund, but it's a refund beyond what was paid in payroll tax. There's a kicker on top of it that's like a subsidy, stimulus. We request the organization charts, or at least talk about them, to understand whether the company owns, the ownership of the company owns other businesses as well, because you have to look at this on a control group basis. So to the extent fire fewer owners of the company own another business or control that, you have to look at the gross receipts and the employee count together. Government mandates, what this really means is we just want to, let's go back. Sorry. We just want to have a conversation with you about what your experience was during the COVID-19 government order heavy time period, which started in 2020 and went through 21, started to lift a bit as 21 went on. What your experience was, how your business was affected. We do the research, identifying what the particular government orders are, what their duration is, and then we need to connect that to how the business was affected. We will also ask for what the gross receipts were by quarter for 2020, and 2021. In both 2020 and 21, we're looking at each quarter, and we're comparing back to that same numbered quarter from a calendar perspective in 2019. And we're looking for declines, significant declines. That's defined for the 2020 period as a more than 50% decline. And for the 2021 credits, again, those credits are quarters 1, 2, and 3 of 21, of a more than 20% decline. Even when we're focused on the partial shutdown analysis, understanding how government orders were affected, we're still going to look at the gross receipts to see if there's some, maybe you don't hit it automatically due to the gross receipts, but maybe there was still some trailing downward sales due to your inability to operate or have a partial shutdown. Also, we talk about what you received in PPP. This is a long time ago now. PPP started to be issued 3 years ago. Second round came in early 2021. And so we get the forgiveness applications to understand exactly how much was received in payroll protection and understand what the covered period was. Even if those wages, even if that funding from a PPP perspective went to fund all wages in the 2020 or 21 periods, the covered period over which you can allocate that is different than the time period of the credits. And so there's a mathematical analysis that we do where we can look to allocate PPP funding among wages during the entire covered period, even though those wages really covered probably only the first 8 to 10 weeks, the covered period is more like 24 weeks. Said differently, you can't double count the amount of wages funded by PPP. You can't put it into the ERC, but you have flexibility in terms of how you allocate that PPP funding among individuals who are employed by the company, and perhaps it can be allocated to wages that would have never generated an ERC in the first place. Last thing, when we do this project, we have to get the wages by person with the potentially employee number. Basically everything, so we understand exactly who was getting paid, and we get it by paycheck date. And oftentimes as well, we get it by department and with a job title. And the reason for that is there are 2 regimes under the employee retention credit. One is for large employers and one is for small employers. So for a large employer, which is defined as for the 2020 credit, a company with more than 100 full-timers on average in 2019 and more than 500 for the 2021 credits, you can only include wages paid to individuals who were basically not working. And so in order to do that, we like a better mapping of the organization and understand exactly what the job functions were, so that we can then work with the company to understand exactly who may have been paid to, as a statute will call it, to not provide services, basically keeping people on the payroll instead of tossing them out onto unemployment. You get a credit back for that. And that was what this thing was originally intended to be. It was then expanded. And it really, for the companies who are small, who have fewer than 100 or fewer than 500 for 2020 and 21, you can include the wages you pay to everybody. And so maybe you wouldn't need this detailed amount of information. We'll talk a little bit more about some of the abuses that I've seen out there with respect to that by some of the consultancies. But again, I think my point here is that we talk at a deeper level than I think other companies do, who will just say, you can qualify for up to 26,000 per employee. There's quite a bit to analyze. We can do it quickly and I think efficiently, but we try to start with this mapping for everybody to understand exactly what we want to talk about. Let's move on to the next slide.
And Marty, I do want to make a point. Sherry Becker, the people that you're going to talk to in the complimentary scoping are tax professionals. It's going to be Marty or myself or members of our team. It won't be a telemarketer. We're very well versed in the nuances of the code, which will, the CARES Act rather, which we'll dig into. And we've got years of experience doing this. So I think that's a significant differentiating point for Sherry Becker.
Yeah, it is. And the other thing as well, technically speaking, over the last since 2021 early, we've done a full analysis and filing for about 950 plus companies. We haven't done 20,000 because we're not just doing everybody. We're going through and we've probably talked to twice as many, just to and many companies don't qualify. So the point is, we've had a refined approach. We have people who are former Treasury as well, former WNT from some of the big fours. Both Carolyn and I are former big four, and that's where I started working with this when I was at the big four before I came over to Sherry Becker. With that said, the scoping is, as Carolyn said, it's a complementary because we want to help companies get these credits, maximize them, but also we're going to sign this tax return ultimately for purposes of the filing. So it's our position as well. So we need to get to a more likely than not position that you do qualify as an eligible employer for purposes of this credit. But we'll meet with you, we'll talk it through, we'll go back and forth and develop the position. Sometimes it's easy if you have a good story with respect to the gross receipts of clients. Sometimes it takes a lot of research and we're more than happy to put in the time. This is relationship development for us, client service for us, and we're proud to offer it and do it. And it's been wonderful. And we've seen a lot of clients also start to get their checks more quickly from the IRS lately. Generally speaking, after you do a filing, it can take, I would say on average, about 9 months to get a refund from the service. They don't have a method for electronic filing for the most part, and that requires a paper filing then. And so it is a little slower, but I have seen these things come back in like 3 or 4 months lately sometimes. So it's a little bit of a black box in terms of how quickly you will get back, but I would say on average, expect 9 months if you do a filing for the ERC. Okay.
And Marty, I do want to note, yeah, you mentioned that we sign the tax returns, so it is our claim. So we make sure that there's a position. We are also able to support any potential audits or correspondence with the IRS, which we've been seeing an increase in recently, but it really is more of kind of an administrative paper pushing exercise, but we're here to support our clients through that whole process.
Yeah, and what we are also beginning to do is starting to work with some clients who've worked with some of the consultancies out there and have inadequate documentation to support inquiries from the IRS. Specifically, I have seen a lot of filings made under the position that government orders were limiting what we could do, and the government orders cited are simply OSHA or CDC guidance that was present before COVID, present today, and it's not technically a government order specific to COVID-19. It's not enough to satisfy a claim. I've also had some audit clients who've taken that, and we haven't been able to allow them to take a financial statement benefit, even if they've gotten the cash, due to the fact that they have inadequate documentation and potentially don't qualify. So with that said, we're working with a number of clients to, we'll call it perfect the claim, and work with the service and correspond. And we can do that efficiently. So if anybody has, I don't know, any doubts about whether on anything they've filed for, or if they have any inquiries going on with the service, we're more than happy to step in and help. Let's move on. Okay, so approach for clients continues. Essentially, when we provide the final deliverable to a client, it has the full documentation and a technical analysis indicating why they are what's known as an eligible employer, i.e. why do they qualify for the employee retention credit? What were the government orders limiting the business causing a partial shutdown? How long did they last? What were the facts of the business and how they affected it? Or what were the gross receipts on a quarterly basis, 19 over 21, and showing that significant decline? We will have the calculation done in a very detailed spreadsheet showing exactly who gets the credit based on each pay period and what wages were funded by PPP. Overall, again, this is a very, very deep analysis in terms of what you can qualify for, what the credit is, and we have our own systems as well. They're somewhat proprietary. Some of it's math, so I don't know how proprietary that is, but I would say from a formatting perspective and from a method of expressing exactly what was claimed and how there's no double count with PPP, I think the intention is to make it clear to our clients and to the service. So what we have, and we say it's correct, is an audit-ready deliverable. But what we suggest is that when and if the IRS were to ask any questions, we can be very specific in the response. Everything's there, but we also like to be very specific and parse back to the service exactly what they asked and not give them more or less than they asked for. We haven't seen too many audits yet. I'm starting to see more come through right now. I think the service has been behind, and I think these things will go on for years as we continue. This is a lot of money, and the statutes will remain open. One more thing, I always think of things to talk about, but is you can, and that's sort of the whole point of this seminar, the 2020 employee retention credit can be claimed up until April of 2024. The 2021 ERCs can be claimed up until April of 2025. So there's a long tail on this. There's time to reflect and think about how your business was affected. Reflect too long, you'll probably forget because it's so long in the past, but there's time to take a look at this. And it's also, I would imagine anybody who's on this and attending it has been thinking about it or thought about it or claimed it, but, or maybe just getting CPE, but sometimes you don't know until in retrospect, you can see exactly how a supply chain disruption truly affected the business and how to adequately pull together the documentation to support that it happened. I'm sort of going on, but the whole point was there. You have time. Those are the two statutory dates for filing. Let's move.
Marty, I want to address your statement. You have time. What we're finding with a lot of the clients that we're talking with is they're getting feedback and noise from some of these heavy marketing campaigns saying there's a sense of urgency, urgency, urgency. You know, time is running out. Marty just laid out the time frame. There is time to be thoughtful in the analysis. It is not, if you're feeling pressured and they're saying you got to file, that should be a red flag. There's time. I mean, look at it. I'm glad you guys are on the webinar learning more, but there is no gross sense of urgency.
Technically, time is running out for all of us, but we will we will think about this with you and do a I don't know, thoughtful filing to the extent it's necessary. You don't have to act tomorrow. It's okay. Okay, so let's talk about some hot topics here. This is now industry focus. From the perspective of industry, let's talk about a few misnomers out there. One is in the context of private equity. So to the extent a PE owns a number of portfolio companies, 99% of the time, those portcos do not need to be aggregated together for purposes of the gross receipts test or the employee count test, which we'll get into more. I said we were doing this backwards. We're going to get into the rules later, but I wanted to get the stuff everybody cares about up front. So if you know you're owned by PE or you are a PE fund and you haven't claimed it, you can definitely look at the different companies owned by PE separately. From an industry perspective as well, we've worked with a number of law firms due to the fact that the court closures due to COVID-19 caused a partial shutdown for them. Even though it's not on the office per se, the location of the courts is a de facto workplace of many of these litigation firms. And so to the extent there was limited access to courts or the inability to put together a jury trial, or matters got delayed. The duration of the court closures, to the extent they caused a delay on matters before the court in that location, can cause a partial shutdown on the company for purpose of the employee retention credit.
And for law firms,
yeah.
it's not just where the law firm is located, it's the jurisdictions where they're practicing. So it can be more expansive. There's quite a few counties that have shut down courts or prioritized trials and things like that. So we look expansively at the effects.
Another misnomer is that it's for many and most employers, even if you are like a 501c3 or a not-for-profit, you can take advantage of this. When we may talk about that a little bit in the industry stuff, but what we have seen is that many not-for-profits, two things happen. One, they have a lot of fundraising events on their location, at their location. And due to the inability to have too many people together in a room for a period of time, those had to go virtual and they made less money. They weren't able to raise as many funds. Also, to the extent we really take a look at, just keeping in mind, it's not just donations, it's investments count as well. So gross receipts includes almost like any and all amounts coming into the company. And for a not-for-profit, when you do some kind of sale of assets, it's treated as not the basis, not the amount of like basis that you would pay like if you were tax money, but as a full gross proceeds go into gross receipts. So if you're doing some kind of like trading in 2019 and you had a disproportionate amount of like, I don't know, large gross receipts coming in 19 compared to like 20 or 21, you can kind of accidentally fall into this qualification as well, just by the math of the gross receipts declines. So when we say gross receipts, we're looking at everything, including like revenues, dividends, interest, rents, royalties, other income as well. I'll leave that there. Government contractors can take advantage of this as well, but we do tend to look at what the contract looks like. So to the extent they're being paid on just sort of a pure cost plus arrangement, basically the government's funding the wages for the company, and then you can't necessarily take a credit on that yet. Basically have to give it back to the government. So oftentimes we're looking for some of the T&M work and some of the firm fixed price work in the government contractor context that can be easily pulled out, carved away with the time tracking analysis that we can get for a government contractor. They all tend to have time tracking. So there's work to do there as well. Supply chain disruptions. You'll hear a lot about this, you know, hey, I had a supplier, I couldn't get some, so therefore I qualify, maybe. You need to identify who the supplier is, where they're located, what the government order was on that supplier, and then you need to show that you couldn't find another supplier. And then you need to show exactly how it caused a partial shutdown. If you have some supply chain disruption, but your gross receipts are going through the roof, you're going to need to find some really good facts to establish that a potential supply chain disruption somewhere in the world affects you and affects the business. What we've seen though is that you can show like delays in lead time as potentially a harmful thing. We used to be able to like get this, somebody would order, we get it out in like 3 weeks. Then it went to 6 months in 2021 due to government orders potentially. And here's another thing, potentially outside the US as well. So when we talk about government orders, there is no specific preclusion against utilizing foreign orders. It's not explicitly stated in the rules either, but we have had discussions with the service on an informal basis around this, and have gotten positive feedback with respect to the ability to use foreign government orders for purposes of the employee retention credit. And a lot of the time, that is what will be driving the supply chain disruption. You'll see plants in Mexico or shipping out of China and Taiwan that may have been delayed for a period of time. We see a lot in the auto dealership context at times. So we're going to get to that now. So let's move to the next one. Okay, so this doesn't give you a lot of examples. The description under here isn't much, but I'll talk about what I mean. We see companies qualifying either under the government order test or the gross receipts test, right? And so from an auto dealership perspective, it's generally the government order test because auto prices skyrocketed, especially for used cars during during the pandemic. And so they might have sold fewer, but we're getting a lot more money for it. And so what we see is in 2020, restrictions on entry to showrooms might cause a partial shutdown. And then for 2021, kinks in the supply chain due to shipments of auto parts and autos from outside the US will cause a supply chain disruption there. And then we look at the lead times, we look at the number of autos sold in that context. Educational institutions, we've done a lot of work with schools, high schools, grade schools, and colleges as well. I have seen some gross receipt declines here, and that generally comes from changes in the investment income makeup in 2019 compared to 20 or 21. They tend to have a sort of constant amount of revenue coming in from tuition payments, but it's beyond that that causes the spikes up or down with respect to some of the other stuff. But educational institutions were subject to very strict restrictions when it came to how many students could be in a classroom, how many people would be together in a dorm, cafeteria, whether or not they could offer those kind of services, extracurriculars, summer school, all that stuff that was precluded from, basically they couldn't offer the full curriculum that they had. And so as a result, recruiting went down, et cetera. So we just look at all the facts and circumstances around that. I would say the same thing is somewhat true of religious organizations and churches as well. You saw, and again, by the way, these are state by state at time restrictions. So you'll see in different locations, the time period of qualification may be different than it is compared to somewhere else. But, you know, in 2020, a lot of locations that have religious services went virtual or were closed and couldn't offer the full amount of services they did, yet still kept people employed and kept people on the payroll.
And Marty, similarly to schools, it's the extracurriculars, like the gatherings, the summer programs, things like that, that were precluded.
You bring up
governmental orders.
You bring up a good point, because in certain states, for example, like North Carolina, I think the state Supreme Court came in and said you actually can't put a restriction on the religious services. So you saw one in place from like March or maybe April until June or July, but still they were offering weddings and extracurricular, and like their hall was available, and that was still restricted because that wasn't technically a religious ceremony. And so nevertheless, they still can qualify, even though the specific restriction against putting a mandate on any kind of religious service was no longer a viable thing. Point being, yes, we look at everything. It's a very good point, Carolyn. It's beyond just the religious aspect of the religious organization. Sometimes they have other functions beyond that from a secular perspective. All right. Tech companies, these are tougher, in my opinion. You see a lot of companies, these places work virtual. A lot of times they're full of software, oftentimes software engineers, virtual development, things like that. Nevertheless, we look at the gross receipts and we see more gross receipt examples for these companies qualifying than we do under the supply chain. There's no supply chain issue for the most part. What I have seen though is, let's call it an R&D company. If it's like a life science company or an R&D company that had to have people working in a lab environment together, and that got shut down for a period of time or restricted, that actually is a pretty good fact pattern, at least for 2020, until things loosened up. I've also seen for a life science type company, FDA travel restrictions that precluded the FDA from overseeing clinical trials. That caused a delay there. That was enough to allow for qualification as well. And so there's a lot of things to take into account. Industrial manufacturing. I see both gross receipt and supply chain examples, and also government orders in 2020 not allowing too many people to be too close to each other on a manufacturing line. All three can combine to create a pretty good fact pattern for purposes of qualification. Healthcare and medicine. Some of that goes in the R&D stuff I was talking about before for the life science stuff, but also I have seen some companies that sell medical devices into hospitals where they could no longer go to the hospitals to meet with the doctors to demo whatever the device was, or have access to the doctors at the time period. And sometimes it's also servicing certain equipment as well within hospitals, due to the fact that hospitals were limited to just personnel who needed to be in there during COVID outbreaks. And so if you were selling into a hospital, if your sales organization was limited from going in there. One more thing. I'm just thinking of things as we go. These all come up. I thought these slides would jog some memories. Another position that some companies will take, and it can be valid, is a sales organization, generally speaking, will attend certain trade shows and conferences. Oftentimes those were like pre-planned and were canceled in 2020. I've seen that position work, and I've seen it be valid for purposes of causing a partial shutdown on what's called a more than nominal portion of the business. So if the sales organization is more than like 5 to 10% of what's going on at the company, and they couldn't then go to their normal conferences, which tended to generate leads and relationships, et cetera, and that can be demonstrated through some of the numbers, you can utilize the restrictions on the location of the trade show as a de facto workplace of the company. So for example, if you were to attend something in Vegas that was a big revenue generator and business development, and Las Vegas has specific restrictions on hotel conferences for a period of time, that can be your de facto work location for that. And that can be a more than nominal portion of your business for purposes of the employee retention credit. But I've also seen that position abused, not by our clients, but by others, where, hey, you know what? We had this conference that was going to be scheduled in 21, but it wasn't, we think, because COVID was there. And we all met virtually and it was fine. We made more money than ever, but I couldn't take my trip to Vegas that year. Not enough. So there's a lot to do there, and I'm using an extreme abusive example, but just be wary of that position and document it. All right, let's move on. Oh, cool. All right, ERC advertisements. So I just copied this from something I saw, and something came into me like in an email, like, hey, you can get up to $26,000 per employee. Trust me, the IRS knows that everybody's pitching this, and they have very specifically warned taxpayers about the over marketing by what they call ERC mills. Something else to keep in mind here too, and this is for tax preparers out there. A lot of times what happens is a consultancy will do your employee retention credit calculation and then give it to you. Then you need to find somebody to go file it for you and sign the return. And you try to then, a CPA firm has to rely on what this other consultancy says. They really can't, unless it's well documented. They need to independently evaluate it, which is why it's so much easier sometimes with us, where we're doing the evaluation and signing the return. One thing to keep in mind is when you claim the employee retention credit, it's actually taxable in the past by virtue of the fact that you need to reduce your deductions for wages in 20 and or 21 by the amount of the employee retention credit, reduce it downward, which is an increase in taxable income. And so you may have to amend your returns for the prior years. Even if we, as a CPA firm, somebody did an employee retention credit and they wanted to reduce their deductions, which you think is sort of a positive aspect, like you're paying more tax in income tax. You're kind of, if you don't believe in the ERC claim, you're perpetuating the fraud. And so we can't do that. So we need to, even if we're just doing the income tax preparation and reducing those deductions, we need to, and you did it by somebody else, we need to look at that, and we can't do it if we don't believe in the position. So I think anytime you work with a consultancy who doesn't do the actual filing, or at least sign the return for you to file, where you countersign as a taxpayer, I would say look out. These are the things. Look at how vulnerable some of the IRS guidance may be. I don't know what that means, but I saw it written down somewhere, and I just think I think the guidance came out quickly. I think it's actually pretty good, considering like how quickly it came out over the period of pretty much just 1 year, as this was expanded and then pulled back a little bit. It's pretty interesting.
My favorite, Marty, is how involving your congressperson may just might get some ERC claims popping. Tell me more about that.
Well, I would say just involving my congressperson hasn't helped me with anything. So I don't know. I don't know how it would be for this. Yeah, I think that's just something to talk about that they want to have like a conversation about. I've seen companies write to their congressperson, they still didn't get the money, or they still didn't get it as quickly as they wanted, but then they did.
Right about 174, not ERC, right?
Yeah, exactly.
Mhm.
We'll do a whole other webinar on something else anyway.
Yeah.
So, how the window for ERC claims will be closing soon if you don't act. That's the thing that Carolyn was talking about. Just be wary of anybody that's pressuring you into looking at this thing. This says rounds 1, 2, and 3 of ERC, how they're different. I can talk about that for a minute. Round 1 was the 2020 credit. Round 2 was quarters 1 and 2 of the 2021 credit. Round 3 was technically just quarter 3. Round 3 has a 5-year statute of limitations on it for purposes of the IRS to look at it. So you're open to exposure for a longer period of time. I think also, if you're making a big government order mandate claim in quarter 3 of 2021, they're pretty wary of too many government orders really limiting a business that hadn't adapted yet to what was going on in COVID, especially you have increasing gross receipts. So keep an eye out for that. And again, we're happy to consult with you on any of this stuff. All right, let's go. All right, only polling question 2. My goodness, you people, thank you so much for staying with me during this period of time. Was your business impacted by government shutdowns? Yes, no, unsure. All right, I'll be quiet for a minute so everybody can take a little break while we wait for the responses to come in. I think what this is getting to is what your local or state government would deem an essential business, and essential business are generally speaking immune to the majority of the government orders out there. They could continue operations. Nevertheless, there were still some at times social distancing things that were in place that had to be observed despite you being a essential business, or the supply chain disruptions might have affected the essential business. I should really answer these things so I get credit. Hang on. Cool.
Marty, was your business affected by government shutdown mandates?
Interesting. I've seen accounting firms claim it, and I've seen them legitimately claim it due to the fact that they're generally large employers. They had more than 100 employees, and for periods of time, they weren't allowed access to client locations for purposes of audits.
Mm-hmm.
And they kept people on the payroll who didn't have work to do. But that was short-lived. All right, let's move on. Cool.
Marty, real quick, we keep talking about government mandates in the different industries.
Yeah.
It's not enough to just identify a government mandate for the area in which your company resides or a de facto place of work. You need to link the facts and circumstances and your specific circumstances to the government order. That is critical. And when I'm reviewing some other providers' deliverables, that's what we're missing. There'll be a very general statement and a list of government mandates, but I'm missing the tie. So that is critical in terms of eligibility.
Excellent. All right, so now we're back to the bread and butter of the employee retention credit. Carolyn, feel free to jump in if you're bored of hearing my voice, but I'll go through some of this stuff right now. Again, there are 4 credits. There is 1 for 2020 and there's 3 for 2021, which correspond exactly to the first 3 quarters of 21. Both are refundable tax credits, meaning a portion of it is a non-refundable piece, meaning it's the payroll tax you paid refunded to you. The refundable portion is the part that we'll call the kicker on top. This is technically calculated as a credit equal to 50% of the first 10,000 paid to any one employee in the period of eligibility in 2020, or 70% of the first 10,000 paid to any one employee during the eligibility periods of 2021, of which there are 3. As a result, you can get a credit of as high as $5,000 per employee for 2020, and as high as $7,000 per employee per quarter for each of the first 3 quarters of 2021. That's how you get to that 20,000.
Qualified wages include employer paid healthcare amounts. So that can increase up to the 10,000. But if there weren't 10,000 of wages, we can include employer paid healthcare amounts.
And I hope the attendees don't think it's backwards that we're doing the rules after we did all the interesting stuff at first, but
Mixing it up, Marty,
yeah.
right?
Okay, cool. So let's move on. Thank you. All right, so 2020, again, we are looking for either a government order that partially shuts down the business, limiting commerce, travel, or group meetings from the period of March 13th through the end of 2020. Alternatively, we are looking for a decline in gross receipts and say, let's say, for example, Q2 of 2020 compared to Q2 of 2019. If the overall revenue / gross receipts of the business were down by more than 50%, so 50% and a penny, you automatically qualify. And just not to get too arcane, but you will qualify for not that quarter, but also the following quarter as well. But that's not an extra credit in 2020. It's just one credit that is reported over multiple quarters, max still being $5,000 per employee. What I have seen, what it says up top, government mandate more common, it is. It's really hard to show a more than 50% decline in your gross receipts. But let's go to the 2021 rules, and I'll catch up on one more thing too that I don't think I addressed in here. Okay, so gross receipts is more common here because you only need to show a more than 20% decline in your organization's gross receipt. I was going to say business, but a lot of these are not for profits. Your organization's gross receipts, that's fairly easy to fall into, and you actually can look at both the current quarter. Alternatively, you can elect to utilize the prior quarter as qualifying. So for example, if in Q1 of 21, you're only 19% down from a gross receipts perspective due to compared to Q1 of 19, you can use the prior quarter, which is Q4 of 20, which is technically in the 2020 period, but you can use it for qualification in 21. You can look at Q4 of 20 compared to Q4 of 19. And if you're 21% down, that meets a 21%, more than 20% decline for the 2021 credit. You can look at the current or prior quarter for purposes of qualification, which means technically speaking, if you qualified as a more than 20% decline in Q2 of 2021 compared to Q2 of 19, you automatically get Q3 because that's the prior quarter to Q3. So I said that quickly, but sometimes you can get double qualification just based on a decline in one quarter of 2021 of more than 20% compared to the same quarter of 19. Again, we see gross receipts being more common. I do see the supply chain argument being very common in 2021. It was not that common in 2020 due to the fact that it was unclear how delayed our supply chains were because nobody was even going out. It really started to kick in 2021 where they could understand exactly what the lead time disruptions were, et cetera. There's also what's known as, there's a startup business credit as well, disaster recovery business. To the extent you started your business after February of 2020 and you are not yet to a gross receipts on average of more than $1 million in the business, you can actually have a potential Q3 and Q4 of 2021 qualification for
It's capped at
yeah,
50,000 a quarter.
At 50 grand a quarter, so up to 100,000 for those two. That's interesting and fairly easy to qualify for if you started a business. Basically, think about it. They're encouraging starting a business during a period of COVID downturn. So that's what they're helping out with a little bit more, but it's limited to just 100 grand, 50 grand for Q3 and 50 grand for Q4. Cool. All right. Partial suspension of a more than nominal portion of the business. Basically, let's talk about it this way. The IRS rules say that you have to have more than a nominal portion of your business shut down. It can't just be like the weird little salad bar inside of the grocery store that was shut down, but the grocery store was open because it's essential. It has to be something that on which you spend at least 10% from a safe harbor perspective, 10% of your hours or generate 10% of your revenues from in 2019. So think about how big your sales organization is. Think about how big one particular aspect of the business was that was limited by government orders. That's what they mean by more than nominal. It's not necessarily a more than 10% decline in gross receipts. It's really, was this government order affecting more than just a little bit of the organization? And so that's what we're looking for. And that's the way they'll articulate the question when it comes to IRS inquiry later on. Okay, let's move on. Gross receipts. I talked about this earlier. We are talking about not just revenues, sales revenues. We're talking about that plus any other amounts, dividends, interest, rents, royalties, annuities, other income. And when it comes to tax exempt entities, gross receipts means basically it's not reduced by the adjusted basis when you have an asset sale. It's the full gross proceeds. And that's why, let's say you sold some stock. It's the full gross proceeds on the sale of stock, not just the upside and the basis. Comes up occasionally when we're looking and talking to not-for-profit entities. We just want to be very clear that it's not just sales, because sometimes you're going quickly and you got to make sure you're asking the client, what else did you have from a full P&L perspective, in terms of what the basically amount of cash coming into the business. Oh, and last point, cash or accrual accounting. If you are cash accounting for tax purposes or accrual accounting for tax purposes, you have to have the gross receipts measured on tax or accrual respectively. So it does follow your tax method. So let's keep that in mind as we're understanding. Sometimes we have to do accrual to cash or cash to accrual conversions as we look at these things to match up with the way it's reported for tax purposes. Qualified wages. This is the large and small stuff. So large employer versus small employer. In 2020, if you had on average more than, well, let me put it this way. All measurements for this thing, whether it's the baseline that you're comparing back to for how big your employee count is, how big your revenues were, your gross receipts were, they're always looking at the pre-COVID year of 2019. And so they want to establish whether or not you were a large or small employer in 2019 compared to 20 or 21 in terms of how you calculate this credit. And so you need to look at your average full-time employees in 2019, essentially look at who at the company worked every month of 2019, 130 hours or more. If they worked 129, they're not part of the count. If they worked 130 or more, they are. And you add those number of employees up each month, add them up, divide by 12, and that's your average amount. If it's 100 or fewer, you're a small employer, meaning your qualified wages are wages paid to everybody at the company. If you had 101, you're a large employer, meaning that your wages, your qualified wages are those paid to people not providing services, which is going to be a much smaller amount.
And it's including, we can include wages paid to part-time employees, even if it's 129 hours per month. So a lot of restaurant businesses, theme parks, even schools have quite a few part-time employees. So that's an analysis that we really dig into because, as Marty just mentioned, the benefit is very different. And on
the next slide, we're going to switch to 500. So they really liberalized it for 2021, and they made the small employer definition equal to 500 or fewer full-timers on average in 2019, which means a lot of companies can get a maximum credit like of wages paid to everybody, full or part-time in 2021, if they had a more than 20% decline in their gross receipts, or they were still limited, partially shut down due to government orders. That's why these credits are so big. Yeah, had they not done that, it would have been a much smaller thing. There would have been a lot less abuse, but it was not wrong. It was a good attempt to quickly get stimulus into the economy, and you know what? It worked. So, and it's provided back a great benefit to a lot of companies. Full-time employee count, we just went through this. It's the 130 hour stuff that I was talking about. Let's move on. Okay, control group analysis. Point being here, you just need to look at not just one business entity, but to the extent it is controlled, and especially in the for-profit context, if it is owned by, even if it has different EINs, if it has common ownership of more than 50% by the same 5 or fewer individuals, you need to count up and look at the overall organization chart to understand exactly how many employees there were and what the gross receipts were on a control group basis. Additionally, generally speaking, the family members of the controlling owners and controlling owners themselves, to the extent they're employees, are not permitted to include their wages in the benefit calc. They're not qualified wages because the government did not give an incentive to not fire your family. So they thought you would probably, at the last resort, keep your family on the payroll more than anybody else, and so you don't get to include yourself or your family members And it's a pretty broad definition of who family members are, but we'll look at that as we look at, isn't there? All right, polling question 3. Did your business apply for and receive a PPP loan? Yes or no? Again, point being that you can't, oh, this is good. This is important. So this was not clear at the beginning. PPP funding, we thought went into gross receipts. It doesn't. That became clear in August of 2021, well into the time period after many of these had been claimed. And so a lot of companies didn't know that they qualified, which is why they went back. So, you know, if you're ever, when people say the rules are changing, they definitely were up until August of 21 in terms of like PPP funding or shuttered venue grants or restaurant revitalization fundings. That does not qualify as gross receipts. So you don't have to include that as you're looking at your gross receipts calcs in 21 compared to 2019 or 2020 compared to 2019. And so I think the answer here is gonna be like 99% yes. Whoa, no, 54%. Interesting. That is very interesting to me. I'm quite surprised. So we might have a lot of larger organizations on here. We shall see. Hopefully they all call us to at least have a talk about this stuff. Maximizing the ERC. Point being here as well is just that you have some fungibility with respect to the wages to which you allocate PPP funding for ERC work paper purposes only. And so you may have had an 8-week period where you funded everybody with PPP, but technically your covered period was 24 weeks under the PPP loan. So you have that 24-week sliding scale period in order to where you allocate for ERC work paper purposes to whom you are funding the wages. And so again, we look for people who made more than 10,000 in a quarter, and we allocate that way because they wouldn't qualify for an ERC anyway on that number. And so that's the maximization. And it's not a gimmick. It actually is intended by Congress for purposes of like allowing 2 sources of stimulus in order to help businesses as much as possible. Let's move on. Okay, more hot topics. I maybe meant to move this to the front, but we can keep it hot toward the end. I talked about PPP forgiveness, the income tax offset thing. I talked about as well that you have to reduce your deductions by the amount of your ERCs. Also, you can't, if you're claiming an R&D credit, you can't put the same wages into R&D and to ERC, but you'll want to put it in ERC because that's a bigger statutory benefit. Monetization, they're taking 6 to 12 months to be issued. That's probably right. I've seen them quicker. I've seen them longer. And sometimes it's rarely because they don't believe the credit claims, because something got kicked with respect to like some number transposition or something like that when we see an IRS issue. Generally speaking, some kind of issue basically with the originally filed 941 there might have been an issue with. So that's the kind of stuff that kinks it up. But again, we're going to see more exams coming forward and the statute of limitations there. All right, IRS exams. So here's the deal. This is all the stuff that we put in our documents. And this is, again, our service delivery model. Again, we're going to have the original 941s. We're going to have all the employees listed by person, the dates they were paid. We're going to have, there's also another credit as well, by the way, called FFCRA, which is basically allowing you to claim a credit for paying people while they were out for COVID sick pay. We didn't talk about that here, but you can't put both into the same credit calc as well, but that's another credit that you can qualify for. So these exams tend to look at both of them together. I'm just reading these right now. Yeah, they're going to want the original W-2s. Again, how did you identify who was not working for a large employer? How much was in health plan expenses and which health plan expenses went into that? And look, there's more on the next page. Let's go to the next one. Yeah, you get your income tax returns. They're going to look for that to see if you like did the deduction reduction. Your gross receipts, well-defined. First thing they're going to ask for, your PPP loans, your forgiveness applications. This is all the stuff that we're asking for in it because we know what they're asking for. And again, if you are being subject of an inquiry by the IRS and you are having trouble responding quickly or comprehensively, feel free to reach out. We're more than happy to assist, perhaps get an extension. Yeah, so the whole point here is that's all the stuff you're gonna need. All right, polling question 4. Would you like to learn more about how we can help moving forward? Yes, no, or maybe in the future. whatever the answer is here, we just want to thank everybody for being on there on this today. I'm reading some of the polling, some of the questions that are coming in the chat right now. See if I can answer any of that stuff. Yeah, and now they disappeared. All right. I'll get back to anybody that asks a question directly on this. We have all the email addresses, and I'm more than happy to give you a response today. All right. And this is the last thing, by the way. So you all put up with me for another hour. That should be worth 2 CPE hours, but it's not.
Yeah, Marty, Carolyn, thank you guys so much. We did have a few of those questions in the Q&A that were pretty specific. So like Marty said, we have emails. We can follow up with you guys later. You have their email addresses on the slide in front of you as well. So if you wanted to jot those down, you might.
Yeah, if you want to copy question and stick it in an email to me directly, I'll answer you today.
Absolutely.
But we will get back to you ASAP.